This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of the previous session, using the Finance Act 2017 notes and lectures there, left you with a problem to finish off, which hopefully wasn't too much of a problem indeed, where, as it was for 1718 tax year, we had to compute the total pension input that would be allowed. Now that meant that we needed to understand how that annual allowance would work for a year and how, if we went above it for the current tax year, we go back and use up unused allowance brought forward from the previous 3 years, and that thankfully being used on a last in first out basis. So let's have a look at the answer to this to make sure that we've properly understood it. Now then, we want the total pension input for the 1718 year. Therefore, we start with a £40,000 figure. Now, of course, you don't always start with a £40,000 figure. The lowest it could be £10,000, of course, and that depends on your adjusted income, and that's what Note 1 is all about. Aston's got an adjusted income of £120,000 in 1718. Now, that clearly does not exceed the £150,000. Therefore, we see no tapering of that annual allowance. Only if we go above 150 do we start to see the reduction, whereby if we go above 210,000, then we reduce it down to the minimum it could be, £10,000 for the year. But more of that in the next problem. You can be seen from above that working at the current year's AA is used first. Yep, we would use the 40,000 first. Then what happens? We go back and use up the unused AAA brought forward, the AA brought forward on a last in first out basis. So going back to the 2014-15 tax year, this was 1718, so we go back 1617, 1516, 1415, and we start, because it's a LIFO basis, with that year. Now there wasn't anything there, we'd fully used up the annual allowance of that year. Move forward to 1516, comparing the 40,000 with the contributions actually made, and therefore we derive our unused allowances, which again hopefully gives you no problems there, of £10,000 and £15,000 respectively in the 1516 and 1617 tax years. Add it all up, we've got therefore 65,000 as our maximum total pension input for which tax relief would be available without incurring the thing that we'll go on to and deal with in this lecture, an annual allowance charge. But let's just have a look at the further points that we made. Now remember we could go up to a max of £65,000 without sustaining the so-called annual allowance charge. So, if therefore in 1718, Aston made a gross contribution of £45,000, again we work in gross terms by comparison to our limits here, our annual limits. This would be less than his relevant earnings, so that's the first test in terms of allowability for tax relief. You can't go above your relevant earnings. Well, we know that the relevant earnings for the year are £120,000, so £45,000 as a gross contribution is well within that limit. So that therefore would qualify for relief and would utilise all of the 1718 AA of £40,000. So we'd use up all of that £40,000 there. So that would go. And we're then told, and 5,000, because it's a £45,000 gross payment, so 40,000 is fine on the current year, 1718. 5,000 of the 10,000 unused AA brought forward from 1516. Now remember, we go on a LIFO basis, but there's nothing in 1415 to be brought forward. So we then move forward to that, and we use 5,000 of that 10,000, and that still leaves 5,000 of it to be carried forward. The remaining 5,000, as we say there, carried forward for one more year to 2018 and 19. So if 2018 and 19, for one more year, if a £30,000 gross contribution was made, then this would be within our annual allowance for 1819. So no unused AA brought forward would be used, and 10,000 unused AA would be carried forward there. So we would be able to carry forward 10,000 from 1819. The 5,000 unused AA from 1516 would now lapse. When we look at 1819, what we could have done was to go back, of course, to, again, we go back through from 1819, 1718, 1617, 1516. So 1516 would be the earliest of those 3 years. So now, when we move forward into 1920, well, the 3 years back from 1920 are 1819, 1718, 1617. So the earliest we could go back to is 1617. So any unused AA, as we said, from 1516 is going to be lost at this point in time. So what have we got here? We've got, of course, £15,000 from 1617. That's untouched. From 1718, there would be nil because we've said we put in £45,000 in 1718, so immediately use the £40,000 figure there. And in 1819, we're saying that we are making a £30,000 contribution. A £30,000 gross contribution was then made. This would be within the AA for 1819, so no one used it. It would be so as 10,000 would be carried forward. There's the 10,000 carried forward so far as use in 1920 is concerned. So after that year's AA year, it will be unused as follows. So to 2019-20, we'd have the £40,000 AA for that year. The 3 years before it are the 3 that we identify here. We would go back only if we made a contribution above £40,000 in that particular year. If we went above 40,000, what would we then use? We'd start to consume the 15,000 still available from 1617. And if we don't now use that in the 1920 tax year, then by 2021 it will have gone and that will have lapsed and we won't be able to access it at all. That, nothing of course in 1718 and the 10,000 that we've just generated from 1819 there. Okay, so hopefully we're now familiar with how in any one tax year we could either work out for that tax year what the total pension input allowed would be, or given a figure of gross contribution made, we'd be able to identify whether it fell within that total pension input limit by using firstly the annual allowance of the current year and then any unused allowance brought forward from 3 years ago, from 2 years ago, from 1 year ago. But now we meet a new problem, and that is what happens if the total pension input that goes in exceeds the annual allowance limit plus the unused annual allowance brought forward from the previous 3 years. Now at this point, this is the lecture now for 1819, we'll revert back to the 2018-19 notes. So I'd like you to turn therefore in your Finance Act 18 notes to Chapter 10, Section 3, the annual allowance charge. And the example that we'll do is illustration 2 in a moment's time, and that will be based on the 1819 tax year. Now, because for this year, in terms of our requirements, we're going to be computing there not just an annual allowance charge, we're yet to see what that is, but also prepare an income tax computation for the 1819 tax year. So that's why we're not using the lecture here from Finance Act 17. We need to update it so that we do it properly now for 1819. All the rules up until now haven't changed. The rules don't change now. But so that we can get an answer done in current day terms, we're now looking at the example in the updated notes, Finance Act 18. So what's the issue for this annual allowance charge? We know that tax relief were given on pension contributions up to the level of relevant earnings. So as long as that gross contribution is within the level of relevant earnings, tax relief will be available. So tax relief is given on the pension contributions up to the level of the relevant earnings of the taxpayer for a tax year. If the tax relief contributions exceed the AA, the annual allowance, including, as I just said, any unused allowance brought forward, that being from the previous 3 years, then go above that, there will be an AA charge. And what that will do is to claw back the tax relief that would otherwise have been given. So it's a secondary limitation in relation to the tax relief that will be available to you on your pension contributions. The first check that must be done is compare your gross contribution with relevant earnings. Your gross contribution can't go above those relevant earnings in terms of achieving tax relief. If you are within that level of relevant earnings, but those gross contributions exceed your annual allowance limit of the year, plus the unused allowance brought forward from the previous 3 years, then we get this AA charge, which is going to be an additional tax charge within our income tax computation, based, of course, on the excess there of the gross contribution over what your total AA limit for the year would be. So what's going on here, therefore? Also, of course, if there is an AA charge, as we said, chargeable to income tax at the taxpayer's marginal rate. So we're adding it on in terms of effectively the tax liability on top of the taxable income of the taxpayer for the tax year. There'll be an additional tax charge, hence at your marginal rate of tax, as we'll witness in this example. Right, our example. Our hero Villa here has a trading profit assessment for 1819 of £250,000, so relevant earnings of £250,000, and made a contribution into a personal pension scheme during this year of £70,000 gross. Now again, be careful how that information is given to you. If they'd said that it was just the amount paid, then that would only be 80% of the overall gross figure, so we'd have to multiply it out by 100 over 80. Here, for 70,000 to be the gross figure, they could have said, well, 80% of 70, 80% of 50, could have said that he actually paid 56,000. 56 times 100 over 80, if my mental arithmetic is right, will give you 70,000. But it's the gross figure that we use for this comparison. Now, 70,000 is clearly easily within the level of relevant earnings for the taxpayer, so again, tax relief would be given. Villa joined the pension scheme in 1718, in which year he made gross personal contributions of £10,000 and had net income of £90,000. Compute this annual allowance charge and prepare the income tax computation for 1819 as well, showing Villa's income tax liability for the tax year. Now, let's go through this. As we've just said in that brief introduction, for 1819, got relevant earnings of 250, got a gross contribution of 70, so all of that will attract tax relief. But his annual allowance for 1819 is going to be less. His annual allowance limit, his annual allowance itself for 1819 will be reduced to the minimum 10,000. Why? Because the adjusted income exceeds 210,000. We've got their adjusted income of £250,000, so that's well in excess of 210. So immediately, without any further calculation, just bring it down to the minimum that will be allowed, £10,000. As Villa was not a member of a pension scheme until 1718, we don't look back, of course, there over the 3 years. We can only have unused AA brought forward if we were a member of a pension scheme in a tax year. That didn't start till 1718. This is 1819. So the only unused annual allowance that we'll have brought forward is that from the 1718 tax year. So what have we got from 1718? £30,000. How come? He'll have an AA limit was the full 40,000. Why? Because the income for that year was only 90,000. We're getting nowhere near that 150,000 adjusted income limit, beyond which we start to reduce the 40,000 AA figure. Of which he'd used only £10,000, again, as we were told there in the question. He'd made a contribution of £10,000 there. What will his AA charge be? Well, it's going to be £30,000. How come? There's the gross contributions made for the year, given in the question, 70,000. What is the overall AA limit that is to be applied now for the 18-19 tax year? We've got our £10,000 limit for the year. In 18-19, £250,000 of adjusted income. So we've got the minimum £10,000. And as we've just worked out there, we've got £30,000 brought forward from 17-18. So we've got £40,000 in total. So 70,000 minus 40,000 equals a 30,000 AA charge. Right, what do we do with that AA charge? We're going to tax it on the taxpayer here on Aston at his marginal rate of income tax. To establish that, we need to look at his income tax computation. So here we go, his income tax computation for 18-19 there. Trading profit, 250,000. Net income, 250. Personal allowance, note 1, is going to be nil. Now, it may seem very obvious, of course, there, with £250,000 of trading profit, that he's going to have no personal allowance. But remember the valid reason for that. For this, we need an adjusted net income. And for purposes of computing his personal allowance is 180,000. How do we get that? What is his net income, 250, minus the gross amount of personal pension contributions? Again, if we're struggling to remember that, it's chapter 2. Go back, check it out, because again, we need to know how to deal with those gross personal pension contributions in the context of involvement within the income tax computation. They do not show up as deductions on that income tax computation, but they do impact on what goes into that computation. Here in terms of the personal allowance. Now, it's not going to have any effect in this particular case because when we deduct 70, we're deducting it from 250. That still leaves us with 180. That is well in excess of 123,700, at which point, of course, the personal allowance became 0. So it's 250,000 all the way. That is the level of taxable income. But we have gross personal pension contributions. On that basis, therefore, we know that we need to extend the basic rate band, and here, as it will be relevant, the higher rate band limit by the gross amount of the personal pension contributions. Now then, I didn't take you through the note just above this, didn't want to spoil that for you, but let's have a look at what we've got. Villa's contributed to a personal pension scheme, only relevant here on personal pension, not relevant for occupational. So as he contributed to the personal pension scheme, both his basic and here higher rate band limits will be increased by the gross contribution of £70,000. So what would have been a basic rate band limit of 34,500 plus 70 is now taking us up to 104,500. What would have been a higher rate band limit of 150, again the standard figures on your rates and allowances page, add the 70 to the 150 and it's now up to 220. So we need therefore to compute those revised basic and, where appropriate, higher rate band limits before you proceed to do your tax calculation. So, using those revised limits now, basic rate 104,500, the only income is trading income, it is non-savings, so it's taxed at 20%. Again, we are within, that goes up to rather, the limit of our basic rate band, 104,500. We then, of course, go into higher rate band. Now, the higher rate band is, of course, the bit between the basic rate band limit that we've computed and just used at 104,500 and the higher rate band limit at 220. Well, 220 minus 104.5 will leave a maximum amount of taxable income in that higher rate band. The difference between those two, of course, well, that's going to be 115,500. Now, because we've got a taxable income of 250, we've gone above 220, all of that higher rate band limit is used. Again, on that trading profit assessment within taxable income, there's your 115,500, non-savings income, 40%. So we've now taxed 220 out of 250. That leaves, pushed up into additional rate now, the remaining 30,000. The summation of those three figures there would be your £250,000 of taxable income. And because we're now in additional rate, that's at 45%. And again, hopefully the tax calculations there are right, but we just put it through a calculator and get the number. So having done that, we now bring in the AA charge on top of that. And hence why we talk about being taxed at the marginal rate of tax for the taxpayer. Now that marginal rate, as we can see, for what is an AA charge of 30,000 is 45%. Add that in and get your overall income tax liability here, inclusive of that AA charge. Go back, work through that again, make sure that you're happy with it in terms of how we establish any AA charge that arises and how then you would proceed to tax that AA charge. There's one small issue that we need to be aware of, but again, any computations here would not be involved. It's simply an awareness, and this figure again that is actually given on your rates and allowances page. But we're talking about, in terms of everything we've done here, about the amount of contributions that are made during lifetime by the individual into the pension fund, and how, if at all, tax relief will be given for them, and how some of that may be clawed back in the form of an AA charge, as we have just seen. But of course, at some point, the individual will retire and therefore take a pension. So what happens then? That's where this lifetime allowance comes in. Well, when the taxpayer does take their pension, they'll be allowed a tax-free lump sum of 25% of the pension fund, and usually that would be taken. And changes, good changes for taxpayers in recent years, whereas previously the remainder would have been used to buy a pension annuity, which, given since the financial crisis the level of low interest rates that we have enjoyed, I suppose, not such good news if you try to take your pension, because that brings down the annuity return that you'll get. It'll only be a low percentage. So what you can now do, instead of being compelled to buy the pension annuity, the taxpayer may now withdraw the balance of the pension fund as taxable income whenever they wish. It's called a drawdown there from the pension fund. You don't have to commit it to an annuity when rates are low. You can therefore draw down on that, leaving it within the fund and then taking any part of that you wish each tax year, and it will just be treated as income chargeable to tax at the normal non-savings rates. But when you do take that pension, there's another issue, and that is, in addition to the AA, our annual allowance that has limited the tax relief available when you made your contributions, we also put a ceiling on the level of pension fund that you can build up and still take the tax benefit of the 25% tax-free lump sum. So we've got a lifetime allowance of 1,030,000. Now, of course, for most of us normal taxpayers, that is just a dream of ever being able to get anything like that. But of course, if you're in the so-called banking profession, you may have a lot more than that, of course. So you've got this lifetime allowance of 1,030,000, and that applies, as we've said, to the value of the pension fund built up at the date the taxpayer takes the pension. If that fund value exceeds this limit, then an income tax charge will arise on the excess, dependent on how that excess is used. these calculations are not within your syllabus. So you've simply got to be aware that, yeah, there is a limit in relation to the size of the fund from which then you can enjoy the system as it's laid down there in terms of a tax-free lump sum and in terms of how the drawdown or annuity system works. But if your fund has exceeded 1,030,000, then there'll be additional tax charges when you take your pension. We don't need to know about that. Okay, hopefully you've been okay again with that mix of lectures from Finance Act 2017 and now Finance Act 2018. We've had to move to the more recent notes, of course, because we needed to do that income tax computation for our tax year 18-19. But the principles have not changed. Again, as ever, at the end of each of these chapters, the work now that you are able to do, and hopefully will do, at least some of it there before progressing on to the next chapter. That brings to an end the study of income tax at this point in time. What we'll then move to is an issue that's relevant to two types of our earned income, employment income and our trading income, our trading profits of an unincorporated trader. And of course, as well as if you have such sources of earned income, suffering income tax liabilities, income tax charges in relation to it, what you also suffer or may suffer, depending on the level of employment income, the level of trading profit, as you'll see, are national insurance contributions. So eventually, or now finally, we get to move away from income tax and look, if you move to the next chapter in this order, chapter 11, national insurance contributions. Quite straightforward, very mechanical. It's all computation apart from a very basic bit of learning. Learning made easier, by the way, because of the information that's provided on your rates and allowances page. So maybe a welcome break from some of the things you've been looking at more recently.